medium-term, and long-term financial instruments. Let's delve a bit deeper into each category of short-term, medium-term, and long-term financial instruments. 1. Short-term financial instruments. Maturity period, usually up to 1 year, sometimes even shorter, like a few days to a few months. Characteristics. High liquidity, these instruments are highly liquid, meaning they can be easily converted to cash without significant loss in value. Lower risk, generally considered less risky due to their shorter duration, but this can vary depending on the specific instrument. Common usage, used for managing short-term cash needs or for parking funds temporarily, such as in money market funds or treasury bills. Examples. Treasury bills, short-term government securities with maturities ranging from a few days to a year. Commercial paper, unsecured, short-term debt issued by corporations to finance short-term liabilities. Certificates of deposit, CDs, time deposits with fixed terms typically ranging from a few months to a year. Money market funds, mutual funds investing in short-term, high-quality debt securities. 2. Medium-term financial instruments. Maturity period, generally between 1 to 5 years. Characteristics. Moderate liquidity and risk, these instruments strike a balance between short-term and long-term investments in terms of liquidity and risk. Used for various purposes, suitable for financing medium-term projects or investments and often offer slightly higher returns than short-term instruments. Examples. Medium-term bonds, bonds with maturities between 1 to 5 years, issued by governments or corporations. Medium-term notes, debt securities issued by corporations with maturities typically ranging from 1 to 10 years. Certain types of loans, loans provided for medium-term needs, like equipment financing or small business loans. 3. Long-term financial instruments. Maturity period, typically over 5 years, ranging from several years to several decades. Characteristics. Lower liquidity, higher risk-reward, these instruments often have less liquidity, are more susceptible to market fluctuations, but can offer potentially higher returns. Long-term growth, suited for long-term financial goals like retirement planning, wealth accumulation, or funding large-scale projects. Examples. Long-term bonds, corporate or government bonds with maturities typically over 10 years. Stocks, ownership shares in a company, representing a claim on part of the company's assets and earnings. Real estate investments, properties held for appreciation or rental income. Retirement accounts, investment for long-term retirement savings. Annuities, contracts providing a stream of income, often used for retirement planning.